Good morning, everyone. Welcome to the Q3 earnings call of Dolla Financial Services Limited. My name is Kenroy Carr, and I'm the CEO of Dolla Financial. Today, we'll be doing our call a little bit different. So we'll be hosting and moderating our call. And we will, of course, go through our results, provide some insight into what is driving the numbers, and of course facilitate any questions that you may have. So once again, I just want to welcome everybody to the call. I want to thank Learn, Grow, Invest for allowing us to use this platform to kind of brief investors and kind of let them know what's happening in the company. On the call today, we have our head of credit and collections, Kurt McKenzie, who will give us some insight in the loan portfolio and just general operations of the most important asset of the business. We also have David Henriquez, who will be giving some insight as to our subsidiary Ultra and its growth and just what's driving the numbers again. Of course, we have Trevine McKenzie, who is no stranger to anybody on this call, and she will be the most importantly going through those numbers for both Q3 and what we have achieved year to date. And then, of course, we'll just facilitate some questions from you, the audience, as we go through this morning's call. So before we get into this, I'm just gonna invite David, who will whisper a word of prayer, and then we can move along.
Thanks, Kenroy. So, dear Lord, we come to you in prayer this morning, and we want to thank you for all the blessings that you continue to bestow upon us. Thank you for keeping us all safe and healthy to be here to witness this call this morning. Want to thank you for blessing us and guiding us with our investors, our shareholders, our team, and everyone, and keeping us all safe and healthy as we move forward. As we embark on this call, Lord, please continue to bless each and every one of us and keep us all safe, healthy, and to enjoy the life that you continue to provide for us. Amen.
All right. Thank you very much, David. So we are absolutely delighted to present our unaudited, consolidated results for the 9-month ending September 2024. First, I will just go through some key highlights of the performance, both for the quarter and for the year. But throughout Q3, we simply continue to the most important thing is that we continue to remain dedicated to providing exceptional loan services, fostering trust among our customers, our investors, and all stakeholders, and just enhancing the product offerings that we have as we look to continue to drive growth and build the company from quarter to quarter. So let's just go through some of the highlights for Q3, or for the 9 months ended September 30th, 2024. So our loan portfolio now stands at $3.1 billion, which represents $3.1 billion, and this represents a 19% increase relative to September last year. Our loan portfolio, which this pretty much represents about 90% of our asset, still remains like the most important asset for the business, and as such, the quality we are steadfast in ensuring that the quality of the loan portfolio is robust, and that some of the key indicators that we use to track the portfolio are still in check. So in terms of loan portfolio quality, this has remained stable. We have seen an ECL of 3.9% as at September, which represents a slight decline from where we were last year this time. I think last year this time we're about 4.1% in terms of ECL. ECL is really the expected credit loss. So of course, once we disburse a loan in any given loan business or the industry that we're in, you're expected that there is some probability that there will be default. So this has been really incredible at 3.9%, and Kurt will shed some more insight in this, but a lot of this has to do with our secured loan strategy that we continue to employ at Dolla that has really contributed to probably one of the lowest in the industry, for sure. Our NPL, again, this was at 9.7% as at the end of September, a little below still below what we have as a budgeted target internally. It's slightly increased from the similar period last year. And I can say that we continue to monitor, we continue to work on this and try to get it as low as possible each quarter. But what I want to say about the NPL, which is a non-performing loan, is that from time to time, you will have some amount of fluctuation in the NPL. And I believe at the end of Q3, we would have seen a little uptick, maybe about a 0.7% uptick in NPL. And I know for sure that some of this is attributable to maybe one or two significant loans which would have entered that bucket. But these are still loans that we are not so concerned about because of the collateral that we have in place and our ability to work with these customers to get them back in a performing state. And of course, we can anticipate that for this quarter, you can rest assured that we are actually working to get those loans back to a performing state. Our profitability, in terms of profit before tax, we would have recorded a 367% increase in PBT. $369 million increase in PBT as at September. Year over year, this represents a 10% growth in the 10% growth in the profit for the company, which is pretty good. It's still a solid, stable and solid increase in profit year over year. For Q3, there would have been a little fall off in our PBT. I believe this would have been one of the first quarters over the last 6 or 7 quarters that we had PBT of that was below $100 million. But of course, again, Trevin will provide some insight into what really drove those numbers, or what caused the profit to kind of fall off in Q3. And in terms of our efficiency, this is really a test of how well the business is being run relative revenues relative to the expenses of the business. We stood at 48% as at September, which is a slight improvement over last year when the efficiency ratio was about 49%. So this is still a very good performance in terms of just how the business is managing, how the business continues to manage the expenses relative to the income that we are making. Throughout the quarter, of course, while we continue to focus on driving shareholder value, a lot of what we do also takes into consideration the impact that our business have on the society in general. And of course, CSR activities is something that we pride ourselves in. Quarter over quarter, we have participated in a number of initiatives that really, it's really not just about the dollars and cents. Sometimes it's about the impact that you can make. And we were really happy to be, during Q3, while we work on improving the numbers, we were still able to take some time more to make an impact. We facilitated, or we partnered with the Ministry of Labour and Social Security for their senior spelling bee championship or competition. I believe that I didn't even know that those programs existed, to be quite frank, but I'm really happy that we were able to participate in that and make some valuable contributions to one of the members who actually, or sponsored one of the members who actually entered that competition. So that was it in terms of CSR activities. And of course, we continue to just look at initiatives that will continue to drive business growth, customer growth, and of course, profitability. So we would have made some tweaks to a few of our products during the quarter. And I believe that we still have some of those promotions running for maybe a month. I think October, we also had some of these promotions running, but for the summer, we would have had our back to school promotion, our Dollar Scholar, where we made some adjustments to that product. Of course, it increased the business business activity, and ultimately there's still some CSR benefit here, because at the end of this promotion there is a reward for the customers who actually participated. So there's still some CSR activity where this is concerned. And of course, our one and ready loan product, where we focus on taxi owners, taxi operators, to kind of continue to taxi operators, we focus on helping them to become taxi owners, and taxi owners, we focus on helping them to build out on their business. And we have seen quite we have been doing really well in that industry. And for last quarter, we would have introduced 100% financing for certain vehicles in that industry. There are some conditions to this, of course, in terms of the pricing of the vehicle and all of those stuff, but this too has really contributed to an increase in disbursement throughout the latter part of Q3, and we're seeing a lot of momentum into the fourth quarter based on just some of these product offerings. All right, and we continue to the campaign that we have running, we continue to just have underground operations, whether it's partnering with car dealers, partnering with companies that would have partnered with companies that would have allowed us to enhance the product offerings that we have. We continue to do those partnerships. We continue to do those interviews to just highlight what we do and try to widen our customer base, our customer reach, which will ultimately drive disbursements and drive growth in the company. All right, so at this point, I will pause to introduce Kurt McKenzie, who will give us some insight into the loan portfolio and what is driving those numbers. Kurt?
All right, thanks, Kenroy. Good morning and special welcome to everyone. As introduced by Kenroy, I am Kurt McKenzie, Head of Credit and Collections at Dolla Financial. And with that said, let's jump right into it. Okay, so taking a look at the portfolio in terms of secured versus unsecured, business unsecured loans accounted for 7%, whilst unsecured personal loans accounted for just a little higher amount at 8%. That leaves a whopping 85% of the portfolio that's actually secured. This is actually trending in the direction that we intended for both medium and long-term plans. This time last year, the portfolio was approximately 80% secured, and we'll definitely keep on with this trend. Now, let's take a look at the different industries that the portfolio is stretched across. No surprise, we continue to maintain a very diverse portfolio, which we all know minimizes vulnerability and provides room to capitalize on any emerging opportunities. Our major contributors continue to be real estate and construction, as well as haulage and transportation. We continue to tap into the minor industries, but maintain a stronghold in the major income generators outlined earlier. And let's take a look into the performance in relation to this diverse portfolio. As mentioned earlier, the majority of the portfolio is secured at a rate of 85%. And this, I believe, is a direct influence on the two main KPIs, which are the ECL, as outlined by Kenroy earlier, the expected credit loss, which is still single digit and impressively sub 4%. An admirable industry standard is roughly 6%, but we pride ourselves on staying way below this threshold and minimize the expenses related to the provision. Additionally, having a secure portfolio plays a direct impact on our capability to maintain a single-digit percentage of our delinquency, which saw us landing at 9.72%. This, as Kenroy mentioned earlier, is a little higher than we'd like, but with a few major accounts in a non-performing state, they're undergoing the process of having our interest recovered, and as such, we'll just continue to maintain them as best as possible, work with the customers to get them back into a performing stage, or essentially execute our collection efforts to recover in the best interest of the company. With a constantly growing portfolio, we always have to look into our strategies and how we maintain delinquency. So if you could move on to the next slide. All right, it's always an ongoing learning process, right? So with each experience, we learn, we adapt, we improve on our existing strategies. And additionally, to control delinquency, one of the main things that we'll be focusing on is to definitely increase the collection team relative to the massive growth of the portfolio to ensure that we maintain its quality. As I outlined earlier, delinquency with every business, there are always some vulnerabilities. It's just a matter of how we continue to be proactive and maintain it as best as possible. And with that said, I'll be handing over to David from Ultra.
Thanks, Kurt. Appreciate it. Morning, everyone, again. So Ultra has continued to trend in a very progressive and steady way. Our loan book is now sitting at $1.35 billion as at the end of September 24, spanning about 56 active clients. Collateral being held is greater than about $3 billion. As you know, all our loans are secured, and we lend at a loan to value ratio of about 50%. So we are usually very, very well covered in regards to the collateral being held. As usual, the collateral being held includes blue chip stock, real estate, both urban and rural, various motor vehicles, private and commercial, and as well as industrial equipment. As time has progressed, you'll see that our collateral will widen and become a little more diverse as we look to diversify our portfolio. As Kurt mentioned, that definitely leads to more security, and diversification definitely will always work in our benefit. So as we look towards the end of the year, we are aiming to hit about $2 billion, to hit a loan book of about $2 billion by the end of December, which we definitely will be pushing hard to achieve. We would like to continue to maintain an NPL of under 5%. Currently, we're sitting at about 4.75%. But as you know, with the size of the loans at Ultra, it's very easy for these things to get out of hand. So it's something that we focus on and pay a lot of attention to ensure that we do maintain sub 5%. As that will also impact the group's overall NPL. So as I said, we're really focusing on the quality of our collateral and diversifying it just for our security. And also, we're very interested and very focused on maintaining a very robust portfolio. So as we look to end the year, we continue to try to improve our processes, make things easier for our customers, a little more streamlined. They can get loans quicker, and really do try to focus on making the customer experience as good as possible. As I'm sure people have been aware, we are growing our team. For the majority of our time at Ultra, we have maintained a team of 3. We're currently up to 5, and obviously looking to increase a little more as we push to stand alone as much as possible. That is really and truly it for Ultra, and I will hand over to the people's favorite, Trevine McKenzie, who will run us through the numbers.
Thanks so much, David, and a very pleasant morning again to everyone. We are very happy to be here to discuss the numbers as usual. We're going to be doing it a little bit different this time around. So we'll be taking you through our year-on-year numbers like we normally do. And then, of course, we will get into a little bit of a deep dive into the quarter-on-quarter numbers that I know many of our investors and viewers are anticipating. So let us get into it. Now, we're not going to spend too much time on the financial highlights this morning because Kenroy did an amazing job at telling you what's happening there. So total income, we landed at $1.1 billion, which is a 23% increase year over year, which is in the ballpark of what we have been doing over the past few quarters. We've been seeing about 23 to 25% increase year over year. So this is really in the line of what we have been doing. Just moving over quickly to the loan portfolio, which stood at $3.1 billion, an increase of 19% year on year, a little bit lower than we have been experiencing over the past few quarters. And we will take a look into that shortly. Total assets, Operating expenses as well stood at $531 million as at the end of the period, which increased by 22%. We have been seeing increases over the past few quarters, and we will also get into that as well. I'm sure that there are many questions as to, what would have caused the increase. And then just lastly on this slide, the profit before tax, which stood at $369 million, up just about 10% year over year. And we find this to be very good considering the circumstances this year, but we will jump into that a little bit shortly. So let's jump forward. In addition to those movements in terms of our profits, expenses, and income assets, we also had our expected credit losses, which stood at 3.9%. This is actually a reduction from our last year's numbers, where we stood at just about 4.02%. So this is an improvement, actually, and we're really proud of that. And Kenroy and Kurt would have spoken to the fact that we try as best to ensure that the portfolio is in as best quality as possible to ensure that we're able to keep these metrics in line, as well as the non-performing loans at 9.7%. And the efficiency ratio at 48%, which is also an improvement year over year. And we will kind of tie this into how it works with our rising expenses. You will see that with an improved efficiency ratio, the increase in expenses is not really much of a concern, but more of a growth strategy for the income. Now, taking a deeper look at our balance sheet, we had cash and cash equivalents as at the end of the period, which stood at $202 million. And we are seeing where there is a very large change over September of 2023. And this is because we would have seen the very first tranche of the bond raise with Mayberry being disbursed to us. I believe that amount was $400 million in September. We would have unlent just about $200 million of that. And we're seeing where the balance was still sitting in cash and cash equivalents as at the end of the period, which we have successfully unlent in October. So we'll see those movements in the next quarter's results. Loans net of provisions of ECL stood at $3.1 billion, which represents a 19% increase year over year. We are really seeing increases on the Ultra side and on the Dolla side. Ultra really stood at $1.3 billion out of this amount, which is just about 42% of the entire loan portfolio. Of course, this growth is not where we want it to be internally, but it is still a very good improvement over last year, and we will talk about the intricacies of that later on. Loans payable also stood at $2.3 billion, which represents a 26% increase year on year. And we're seeing this increase due to the facilities that we would have received from Mayberry in the last quarter of the year, as well as we had just about $200 million coming from DBJ at the start of the year, which we successfully unlent in the Q1 period. Share capital, of course, saw no increase. And then retained earnings, of course, saw a 24% increase year over year. And this is solely due to the increase in comprehensive income, which we will take a look at shortly, coupled with the reduction in retained earnings due to our dividend declarations. Now, our total interest income would have increased by 17% year over year, up to $353 million. We are seeing this increase year over year due to the funds that we would have unlent throughout the period. As much as we did not do the very large disbursements that we are accustomed to doing because of the funding that we were hoping to receive in the quarter but didn't, we are seeing the ripple effects of the lending that we would have done in Q1 and Q3 coming over into Q1 and Q2, coming over into Q3, which would have helped us to ensure that we saw increases quarter over quarter. We also saw increases to net interest income, which of course is net of our interest expense. moving from $249 million in 2023 to $281 million in 2024. Also, profit before tax would have saw a decrease year over year. We're quarter over quarter from $105 million down to $66 million. And the ripple effects, of course, for net profits as well, which takes into account or taxes. So let's just take a look quickly at what would have led to the decrease in quarter over quarter numbers, So the profit would have ended at 65 million. And we did speak about this. It's a $40 million decrease compared to the 3 months ended in September 2023. The reduction in profitability is really attributed to a 32% decrease in sales for the period. And I did mention before that we did have an influx in cash in the Q4 period of 2023 into the Q1 period of 2024, which we unlent. And we did have a dry spell in Q2 and Q3, which would have, led to the reduction in growth that we're normally used to. So loan sales, because of that, fell by 26% in Q3 compared to Q2 of 2024 and Q1 of 2024. So we did experience growth, but it was a modest growth, just about 19% in revenues for the period. Likewise, it's not shown here, but expenses did increase significantly by 38% quarter over quarter, effectively offsetting the revenue growth that we saw. The surge really is driven by a 15 to 16% increase in staff costs due to a benchmarking exercise that would have been approved by our remuneration committee last year. As usual, we pride ourselves in how we treat our staff, how we reward our staff, as they are really the backbone of the company, and they are the ones that ensure that all the results that we're seeing here today are met and we are able to meet our targets and come on these calls to ensure that we're reporting good numbers. So we would have done that benchmarking exercise, and that would have led to a 15% increase in the largest line item we have on our expenses, which is our staff costs. Legal and professional fees also grew, reflecting higher consultancy expenses and collection costs aimed at maintaining the low delinquency levels that we are seeing. Furthermore, audit fees, management fees, and IT costs as well increased with the growth in the business. And IT costs is one item in particular that did see increases as we ensure that we are able to withstand against all these cyber threats that we're seeing in the market. We have put measures in place to ensure that as best as possible our systems are secure. And audit fees, as I mentioned before, and I have been mentioning over the period, we saw increases in that as everyone in the industry has seen due to the challenges in the audit space. As well as the increases in expenses, we have been mentioning throughout this call or internal financing delays coupled with seeming contraction in the microfinance space, as we have seen other microfinance companies reported for their Q3 numbers, a little bit of a decrease in what they are normally reporting. But even though the economy is set for expansion and BOJ reported growth in the goods market, we are seeing where the services market did not experience any growth. And we believe, apprehension in the economy based on the US election, also what's happening with our own economy with elections next year and all of that probably would have caused the drawback in the services market. But as we did mention also before, we are raising $2 billion through Mayberry, of which we have received $400 million in the month of September. And this, along with other smaller facilities that we have gotten from DBJ and some smaller facilities from Mayberry, contributed to the increase in interest expenses over the period. And that also affected profit before tax. But because the bond proceeds are now in progress, we are confident that the company will return to the growth that we are used to, us and our shareholders and our viewers are used to in Q4 and Q1, even going into Q2 of 2025, as the funds are prudently on lent. Not much to mention on cash. We did go through that. Briefly. We are seeing our 228% increase, and that's because we had some of those funds that we got from Mayberry still sitting on the accounts. Those funds really did come in the 3rd and 4th week in September, and we have unlent those funds in October of this year. Sorry. And if we take a look at our financial summary where we discuss our ratios, we did have some improvements in some of our key ratios. Our efficiency ratio did improve slightly. We saw also all our other ratios really keeping in line. These are the ratios that we look at as well before we make certain financial decisions, before we pay dividends, and just to assist us with forecasting and ensuring that the funds that we're getting are really panning out the way that we want them to. So when we speak about our ratios and looking at our covenants before we make decisions, dividend payments, before we get new funds, these are there, and you can see that there are no major movements in terms of how our financial health has panned out in terms of the funds that we have received and the income that we're seeing. And I know that there are a lot of questions as well about the increase in expenses, but when we see those increase in expenses, there is a corresponding increase in income, and we are seeing where this is reflecting in our efficiency ratio, which is still in line. So there's no cause for concern with the expenses. Once a company is in growth mode, you will see increases in expenses because capacity increases are required to ensure that the company is able to run efficiently and effectively to grow the way it needs to. Now, at this time, I would like to hand back to our Group CEO, Kenroy Kerr, who will take us through the rest of the presentation.
All right, thank you so much, Traveen. So flawlessly executed, as usual. So I think I'm just going to run through some of the things that we plan to do for this quarter and going forward, or what the short-term, medium-term objectives are for the business, and any potential maybe challenges or opportunities that we will see. And then, of course, we'll just go right into the Q&A of this call. So for the fundraise, I believe Traveen would have touched on this in her presentation, where we have been, this is something that has been on our agenda for quite a few calls that we have been on, and I am very, very happy that we are at the stage now where we can say those funds have started to come into the business. As Traveen said, we would have received from a $2 billion raise that we're doing right now, which is a private raise. We would have received approximately $400 million in probably the last week of Q3, and we have begun to receive the remaining funds. Haven't fully closed the bond as yet. We anticipate that will be done in very short order, but we have in fact started receiving the bulk of these funds in Q4, and as such we can expect to see the business getting back to that stage that investors are used to in terms of profitability, growth in revenue, growth in profitability over the next several quarters. So we will start to see the income going back up in Q4, PBT going back up in Q4, and the most important thing is that while we're lending the funds, we're doing so in a prudent way that ensures that other key ratios such as our ECL and our NPL continue to be in line and be best in the industry. And of course, the portfolio expansion will be like a ripple effect or a trickle-down effect from the fundraise that we get. I mean, all the funds that we once we do fundraise, the obvious thing that we're doing is actually lending out these funds. At this moment, that continues to be our focus. So we will continue to see growth in the loan portfolio, which will continue to drive the revenue of the business, drive the profitability of the business, And I would say that our key priorities would definitely be growth in the loan portfolio through diversification, while we continue to place a lot of emphasis on the quality of the portfolio. And of course, we continue to look at optimizing operational efficiency through placing focus on digitalization, just to streamline some of our processes and as best as possible to increase and improve the customer experience at Dolla Financial. We may be looking at exploring one or two locations. I don't believe that we'll be looking at any location for the remainder of this year, but we have already begun to do some assessment to see if it would make sense for the business to actually open another location during 2024. Of course, you know that there are a lot of regulatory requirements when it comes to opening a branch. So even just doing an assessment is the first start, but thereafter we will have to make applications to BOJ and the relevant authority to ensure that we get approval to do these things. But that's just something that we kind of have on the agenda for next year. So I'll just pause here. We can now go to the Q&A. I believe Trevine will be taking us through that segment, and some questions she'll respond to, and of course the rest of the team will be here to answer any questions that you may have.
All right. Thank you so much, Kenroy. This is our first Q&A where we'll be moderating, so a little bit of a switch up there. So the questions are coming in, and the very first one here is from Limitless Podcast. When do you expect to have the funds in hand from your $2 billion bond? I think I can just take that one quickly. The funds have been coming in. I mentioned before that we received 400 million in September, and it's coming in. So we do expect the final pieces to come in between the end of this month and early December. So that's the answer to that question. I hope that helps, Limitless Podcast. And Limitless Podcast, again, who are Ultra's main competitors? David, that one's for you.
So I mean, there are a couple of players in the private credit market. There's Signos, but you know, Ultra does stand apart from everyone else. And as much as you know, it's always good to have competition. Ultra prides itself on speed, efficiency, flexibility. So I mean, we do see ourselves as a very key player in the market. We may not be the biggest at this current point, but we definitely strive to be, and we continue to make all the efforts to be number one in the private credit market.
Thanks for that, David. Very well said. Next up, we have David Rose. Does Dolla have any new partnerships on the horizon to grow the business loan portfolio? That sounds like you, Kenroy.
All right, thanks for that, David. So we do have some partners in place right now. We haven't really announced officially any partnerships over the last several months, but the partnerships that we have in place have been working. For Q3 we are focusing on a new segment, which for Q4 we have started focus on a new segment that we think that there are some opportunities there. I don't want to say the segment right now because I don't want to tip off any of our competitors, but there is a particular segment that I think the benefit will be more for Ultra based on the size of these loans, but we continue to explore these partnerships that will kind of help the business to grow. And we have been looking at a sector and have begun having conversation with some of those key persons that would assist us in bringing those business in. And we anticipate that that is something that we'll probably be announcing in short order.
Thanks, Kenroy. And as a business, just to add to that, David, we're always in research mode. We're always trying to find ways and means to better the business, which means better partnerships, looking at, cheaper ways to raise funds, all of those things. It's a part of our day-to-day. So you can rest assured that these things are always in the pipeline to be coming out. All right. And from Ricardo Peralto. $77 million traded, was that bought or sold? I'll just take that one. That was sold and bought and sold. So yes,
Yeah.
and you can look out for the movements in our shareholder chips in our next publication, which will be sometime maybe around February once we look at our Q4 numbers. So you can just stay put for that one, Ricardo. Thanks. That's a good question. And we have Limitless Podcast again. What are the individual loan book targets for Dolla and Ultra by the end of your next financial year?
So for this one, I can give you a clear estimate at what we'll be looking at for the end of this year. So for sure, we will. We ended Q3 at $3.1 billion, and we anticipate that we'll be somewhere in the region of about between 4.2 and $4.5 billion by the end of this year. Of course, we'll have some funding to take us over into 2025, and we do anticipate that we'll maybe do some more fundraise. So I think we can safely say that we'll be somewhere about 4.5 for the end of this year, and of course next year is just tremendous growth from there. For Ultra, David would have mentioned earlier that, David can speak to this, but he would have mentioned earlier that the target for this year is somewhere closer to the tune of $2 billion. And again, a lot of the funding that we'll be doing will be channeled. A good portion of that will be channeled through Ultra. So you'll see that coming up in the group for us to have at least somewhere close to a 4.5 for the end of the year, and I do believe that the growth will be somewhere to the tune of about 50% come next year.
Thanks for that, Kenroy. Thank you very much and very well said. Up next, we have David. What was the funding source for the $1 billion in new loans received this year? Related parties, DBJ. So I can take this one. It's a mix of Mayberry and DBJ. We had about $500 million that was approved from DBJ so far. 200 million of that was received in the earlier part of this year, I believe January, and then the balance we would have gotten from Mayberry. So thanks for that question. That's a good one. And we have a question from Learn, Grow, Invest from IG. What are the measures that will be put in place to ensure the company continues or exceeds the growth of the business? Kenroy.
All right, so I'll take this one. So the most important thing, of course, we have always said on this call that the business that we're in, we need capital to grow. And the most important thing that we have been working on would have been capital over the last several months. The fall off in the income during Q3, not the income, but the PBT in Q3 was, for me, disappointing, but anticipated. And it's because of the fact that I know that there were some delays in terms of the fundraise. So now that we have the funding, that is what will facilitate the growth and the continued growth of the business. Because at some point we will get to a stage where we can in fact grow the business organically without having to go back to the market or do private raise to get the funding. But the most important thing outside of the funding is ensuring that we are prudently deploying these funds, because you can have the funding. It makes no sense to just be lending without a strategy. So we will continue to maintain those key internal ratios that Trevin would have alluded to earlier. Those are very key for us in terms of lending out the money, but ensuring that we do so in a prudent way that will ensure the continued growth and viability of the business. And that's the most important thing.
Thanks, Kenroy. And just to add to that, in growing the business and exceeding our expectations, we have also put capacity measures in place. So I did mention before that we increased staff, we rewarded staff for the work that they're doing to motivate them as well. So that's one aspect. And we continue to look at technological advancements just to assist us with being more efficient in the business, as well as other things that, as the management team, we have to to ensure that we're forward looking and not being reactive but proactive. So it's a whole suite of things that we're doing here at Dolla to ensure that we are growing in a healthy way. And then Limitless, how much of the net from the $2 billion bond will be allocated towards Ultra? Kenroy, would you like to take that one?
I'll take this one. So to be quite frank, Ultra has its target. So if we will allocate the funding depending on where the need would be. The reality is that the return on these funds, the difference is negligible between Ultra and Dolla. So it's not like we will sit down and just say we're gonna invest 50% in Ultra and 50% in Dolla, because if we're seeing where there's better use for the funds and there's greater potential for growth at Ultra, then of course we'll divert most of the funds to Ultra and vice versa. So right now we don't have a specific target in terms of the percentage of funding, but it's something that David has a strategy working on, and based on his pipeline, if the need is there for a 50-50 ratio, then we will do that. But we will continue to just look at and evaluate where the funding is most needed and where it is most prudent to lend these funds and take it from there.
Thanks, Kenroy. Limitless, it seems like we're going to have to set some time to sit down and talk with you.
Yes,
Um,
I believe so
too. And how much of the 2 billion will be used to pay down existing debt? So I'll take that one. We have carved out just about maybe 300 million or so that we will be using to just clear off some debt that we currently have that we are no longer receiving the benefit, or we won't be receiving the benefit from by the end of the year. So that's just a little bit of our strategy to ensure that we're managing ourselves properly. And David Rose, did Dolla close the $1 to $1.5 billion bond recently? Also, what's the update on plans to list Ultra on the main or junior market of the stock exchange? So I'll take this one. Kenroy, you can jump in, if you want to, but the bond is not closed. It's still ongoing. We did mention this before, that we are receiving the proceeds from that. And of course, the public will know once it is closed. As usual, we have to make our disclosures, so you'll be aware. And then the plans to list Ultra on the main or junior market of the stock exchange. So internally, management, we're doing our analysis to ensure that the listing decision is made based on a structured decision. So we're taking a look at, of course, the benefits, the tax benefit, the marketing benefit, all of those things, coupled with the fact that the increase from 500 million to 750 has not yet been gazetted. And also taking a look at all the other factors, such as the fact that, Dolla itself will be giving up some benefit or some value, just about 20% to the market as well. We're looking at how that will impact our earnings and our investors as well. So it's a 360-degree kind of analysis that we have to do, present to the board before a decision like this can be made. As well as, the 750 really hasn't been gazetted yet, and that's a part of any junior market company's decision right now, whether or not they want to list at this time. So it's really a decision that will take some time, and as soon as a decision has been made, the public will be made aware. Thanks for that question, David. I think that one is a hot topic, a very and then Philip is asking or saying, push for that public bond, please. Yes, we will be looking at that for the coming periods as well. David Rose, how has the rebranding as a private credit provider for Ultra gone so far? Mr. Henriquez, that one's for you.
Thanks, Trev. Thanks, David, for that question. It's gone very well for us. It hasn't been a massive shift in how our day-to-day operations continue to progress, but it was very important for us that we maintain our transparency to the public, to the shareholders, and we wanted them to understand how we've been doing our business and what our business has looked like over the past 2 years. So it has gone, very well for us. Publicity always works. Our pipeline is, obviously getting a little stronger as time goes on, and private credit gets out there. But it has gone very well for us, and hopefully it will continue to go from strength to strength for us.
Thanks, Dave, and thank you, David, for that question. I think that's one we haven't seen being asked. Limitless. If Ultra is spun off, would Dolla consider using some of Ultra's shares as collateral for debt raises? Kenroy, do you want to take that one, or do you want me to jump on it?
You can go ahead, Trevine.
So that one we will take a look at. Of course, if Ultra is spun off, then it can look at ways and means to grow its loan portfolio through debt, and issuing its loan portfolio as collateral could be one of them. So we'll take a look at that one.
Yeah, and I mean it's really hypothetical in terms of the questioning. So these are things that naturally we would internally be looking at just some of the benefits, but also some of the losses that may come with this. The thing is that we have one of our major partner, Mayberry Investments Limited, of course, one of our major strategic partner that is would facilitate a lot of these analysis and discussion. And of course, these things that are being asked, once we are looking at spinning off Ultra, which I'm not saying that we are, but internally these are things that we would in fact be looking at and discussing.
Thanks, Kenner. I think I kind of misunderstood the question, so thanks for stepping in and fixing that. And then David, I see the new Q2 2025 timeline to close Guyana. How is the winding up process going? I wish L.E.A.R.N was here, but Kenroy, that one's
sure. I'll take this one. So Guyana has been we are on track in terms of where we the timeline that we have and the various steps that we need to take. So this process has been going on now for the better part of about 2 quarters, 6 months. And all of the key timeline and things that we need to achieve for those periods have been completed. We would have seen, for example, the reduction in terms of staff complement significantly. I think we have about 25% of complement in Ghana right now. The entire focus in Ghana is just collections, and that has been going well. We've seen really good traction in terms of winding down the loan portfolio. There are a few legacy loans that would have been impacting the portfolio in terms of and that is also in our NPL numbers right now at the 9.7%. So we continue to work on those, but the strategy is really to reduce office space. We have done that, reduce staff complement. We would have paused lending now from February, and the focus has been on collections, and that has been going really well. So far, L.E.A.R.N is doing a tremendous job in terms of just monitoring those key ratios and all of the things that we need to do to ensure that the timeline that we set, we actually meet that timeline. So it has been going good. And it's really a learning process for us too, in terms of just how we go through this and the next step in terms of anything that we look at regionally in the future.
All right. Thank you very much, Kenroy. Let's see if there are any more questions. Philip, approximately what loan book size do you think will allow your collections to cover disbursements? That is a very interesting question, Philip. We have actually taken a look at this, what would allow us to really get there organically, and we believe possibly maybe a $5.5 to $6 billion. The collections from that would definitely be able to allow us to cover disbursements and everything, and just to grow organically without doing much larger fundraisers. But of course, we are an ambitious company, and we are always looking to grow and to add value to the company. So, that one we'll see how it goes. But definitely about $5.5 to $6 billion overall. Another question from David: is the small 0.008 the 0.8 cents dividend indicative of Dolla seeking to retain cash to fulfill borrowing needs from clients? So before this dividend was declared, of course, we did our analysis. We looked at what the 50% payout ratio would have looked like given our earnings, and this is how we actually got to this number. So when we are looking at calculating the dividends, our payout ratio is 50% of earnings, and that would be year-to-date earnings. As you may have, seen, we would have paid out $150 million already based on our year-to-date earnings. And when we did the calculation of 50% of our year-to-date earnings to September, the dividend payout would have been the 0.008. So it's not necessarily to retain cash to fulfill borrowing needs from our clients, because we are receiving funds from Mayberry for that, but it is more so the calculation of how the dividend is done, 50% of the earnings. That's how we got to that small dividend. And it's reflective of the quarterly results as well. They were not as large as we are normally seeing. So, quarterly results weren't as large, and that's what happens with the dividend payment. So it's a one-to-one relationship there. Thanks, David, for that question. And David, Dolla's loan book is over 3.15 billion. Has Dolla explored other lending opportunities to Latin America to develop this portfolio growth? I would say that there is a very large untapped market currently in Jamaica, that we are trying to ensure that we maximize before we start to look elsewhere there, where the jurisdiction and the regulatory requirements are very different. So we're trying to maximize what we have at home first before we start to look outside. And Kenroy, you can add to that. If there's
No,
any.
that's perfectly said, Trevine. That's the main focus now, and especially when you are you're well growing now, having the funds. We raise the funds. We have expenses to of course these funds come at a cost. And I believe that right now the most prudent way to lend it out would be to a market that we're familiar with, a market that, as Trevine says, has large potential and the risk is lower. Right now, I believe that is the best. We believe that that's the best way, the best approach. When we have settled down and I believe exceed our growth phase in Jamaica, then we'll definitely be looking at alternate markets or regionally to see where any potential is for growth. But right now, I believe that based on the cost of funds and the need to just deploy these funds now, the most prudent thing would be to lend it in a market that we are familiar with and where the demand is still outweighing what we're able to facilitate in terms of disbursements.
Yeah, and there have been a lot of questions about growth in the Caribbean and now Latin America. We can't don't play the benefit and how much the market and the economy is growing in Jamaica. Jamaica is one of the fastest growing economies in the Caribbean, and we see real benefit from staying here and maximizing what we have here. Jamaica, it doesn't get better than Jamaica right now, so. That's something that we'll be focusing on, maximizing what we have at home. Let's see if we have any more questions. Okay. What was responsible, and this is from David Rose again, what was responsible for the 27% jump in OPEX in Q3 relative to prior periods?
I think you addressed that one.
You can address that one, Kenroy?
No, I'm just saying that I think if David is still on, I believe you addressed that one earlier.
Yes, I did. I did address that one. I think maybe more than once. Yeah. Any update on any possible acquisitions from Limitless?
So we continue to look at, again, opportunities in the industry. There are, we scout through sometimes the result that we see publicly, and then there are some that come to attention that the market would not know about. And we continue to look at these, but of course, again, the most important thing for us is not just, we have a model that works for us. not to say that acquisition is off the table, but it's not a primary focus for us right now, because the most important thing is actually getting something that aligns with, that doesn't impact the quality of our portfolio. So while if there are opportunities, we do take a look, and if there are any that are significant enough to and show some amount of benefit from the business, then of course we take these to the board level to have some discussion on it. But for now, it's not like it's not like a primary objective for us right now. I believe that we have a demand that the funding that we have, we can prudently deploy it in a way that still aligns with just our culture of lending and keeping some of the key metrics that we monitor to be in line, while we still look sideways to see if there are any opportunities there for acquisition, and we'll continue to explore those.
All right. Thanks, Kenroy, and thanks, Limitless, for that last question, which is the last of the batch. So I'd like to just thank all our participants here who would have shared their questions. We're always happy to answer them and to have these discussions to ensure that you are understanding what's happening in the company, and just so we can all be on the same page. So at this time, I'd like to hand back to our MVP CEO, Kenroy, to just finish up for us.
So thanks, Trevina. Thanks to the team, David and Kurt, for joining me on this call today. Thanks again to the Learn, Grow, Invest. Thanks again to Learn, Grow, Invest for facilitating this call. Of course, we've always said that we will come on this platform every quarter to just give investors a feeling of what's happening in the company. And I believe whether we, for full disclosure, whether our performance is good or whether it's not so great, we can still come and address all of the points that or any concerns that our investors may have. So I just want to really thank everybody for taking the opportunity to join us this morning. Thank you for your questions. And of course, if you have any suggestions, then we also take those into consideration. I am happy that we were able to have a successful call this morning to just highlight some of the key things that are happening in this public company. And I know, again, the results for the results year to date continue to really be solid, at an average 20% growth in terms of income, both interest income and net interest income. And at the bottom line, we're seeing a 10% growth year over year in terms of profit before tax. For Q3, there was a slight fall off, but I'm very optimistic, and I know that with the funding that we're receiving, the growth, we should be returning to normal growth in this quarter, and of course, we should even be seeing more exponential growth in the quarters to come. So thank you again for taking the time out to be with us today, and just wish everybody a great day. Thanks much.